As a retirement plan sponsor, you are responsible for administering your plan and managing plan investments in compliance with the laws and regulations for qualified retirement plans. It's important that you stay up to date with rules, changes, and industry developments so you can continue making prudent decisions regarding your company's retirement plan. Over the next 15 to 20 minutes, I'll highlight the most significant legislative and regulatory developments that occurred during the fourth quarter of 2022, and hopefully explain how they could affect your plan. Three entities drive changes to the laws and regs governing retirement plan rules and tax benefits: Congress, the DOL, and the Treasury Department, primarily through the IRS. This quarter, Congress was the primary driver of change with the Secure 2.0 package that was passed into law at the end of December. We'll cover some highlights of this new law. After that, we'll move on to the DOL's final rules for selecting investments for retirement plans. Then we'll review guidance released by the IRS during the fourth quarter, including the new contribution limits for 2023. We'll close today by reviewing the first compliance deadlines coming up in the new year. Congress included the Secure 2.0 Act of 2022 when it passed the Consolidated Appropriations Act of 2023 to fund the government for the fiscal year. With more than 90 provisions, Secure 2.0 builds on the Secure Act of 2019 to change the retirement savings rules, tax incentives, and restrictions to encourage employers to provide plans for their workers and to help workers save more for retirement. Many of these changes will require additional guidance and detail from the DOL or IRS, as well as administrative and programming changes for plan sponsors and record keepers. To help with this, many of the provisions will not become effective until 2024 or later years. One item that is effective for contributions made after the date of enactment is the option to allow plan participants to treat employer contributions as Roth contributions. This would require the participant to include the employer contribution in taxable income for the year, and the contribution would have to be fully vested when made. This change could be complex to implement for record keepers, and it will require communication and education for participants. If this feature interests you, I can help you explore options with your record keeper. Many of the Act's provisions won't take effect right away, and many, like the enhanced startup tax credits for small businesses and mandatory auto enrollment, won't affect existing plans like yours. But there are provisions that you will be required to incorporate into your plan operations, as well as some that are optional. I will provide more details on how these may affect your plan and when with the next quarter's update. For now, here's a list of just some of the changes you may want to be aware of. A new deferral-only starter 401k plan, subject to the same annual contribution limits as IRAs. Employees may self-certify their need for a hardship distribution. Beginning in 2023, the RMD age increases to 73, and then age 75 in 2033. Roth accounts will no longer be subject to RMDs. The catch-up contribution limit will increase for those ages 60 to 63. Catch-up contributions for employees who earn more than $145,000 must be made as after-tax Roth contributions. Employers may now treat student loan payments as deferrals for purposes of matching contributions. Participants may receive small financial incentives, like gift cards, for contributing to a 401k or a 403b plan. Participants may take one penalty-free withdrawal of up to $1,000 per year for emergencies if repaid, or once every 3 years. Employers can add emergency savings accounts to their plans, which participants can contribute up to $2,500 on an after-tax basis. The cash-out limit for missing or non-responsive participants will increase to $7,000. The DOL will be required to set up a lost and found database to collect information on benefits owed to missing or non-responsive participants. And finally, the service requirement for part-time employees to be eligible to participate in the plan is reduced from 3 years to 2 years. There's so much to talk about with this new act, but no urgent decisions to be made. We'll return to it next quarter. Let's turn now to activity within the Department of Labor. The DOL is tasked with enforcing the ERISA fiduciary rules and protecting plan participants' rights and benefits. During the fourth quarter, the DOL proposed updates to its corrective program for fiduciary violations and published final regulations on those fiduciaries considering ESG investments. As part of its enforcement program, the DOL provides a voluntary fiduciary correction program, or VFCP, to encourage plan sponsors to correct common violations under ERISA and restore losses to the plan participants before becoming the subject of an enforcement action. Common ERISA fiduciary breaches that can be corrected using this program include delinquent plan contributions, improper handling of participant loans, expenses improperly paid by a plan, and prohibited purchases and sales of plan assets. To correct an error under this program, plan sponsors must submit an application and other paperwork to the DOL for approval. The DOL reviews each application to ensure that it's complete and eligible for the program, and to ensure the applicant provided proper documentation. If the correction set forth in the application is incomplete or unacceptable under the program, the DOL may reject the application and pursue enforcement action. If the application is complete and all breaches fully corrected, then the DOL will issue a no action letter to the applicant. This provides relief from the civil penalties and enforcement actions, as well as excise taxes assessed by the IRS. During the fourth quarter, the DOL proposed updates to the VFCP and an accompanying prohibited transaction exemption that would make it easier and more cost-effective to correct certain violations under the program. One major change from the existing program would allow plan sponsors to correct the most common violation, late deposits of employee deferrals and loan repayments, without having to contact the DOL for its approval first. The following requirements must be met to use the new self-correction procedures as proposed. The delinquent contributions must be deposited into the plan within 180 days of withholding from a participant's wages or receiving the amount from the participant. The VFCP online calculator is used to calculate lost earnings based on the actual date of the withholding or receipt, and the lost investment earnings do not exceed $1,000. The plan sponsor must electronically file a self-correction notice with the DOL using a VFCP web tool, and the plan sponsor must complete and retain a self-correction retention record checklist. The DOL is requesting comments on the proposed changes. If you have questions about the current correction process or the types of errors that can be corrected, I can help you find more information and engage a service provider to assist with submitting a correction application and the necessary documentation. The DOL has also been active this year finalizing guidance for fiduciaries on whether and how to consider environmental, social, or corporate governance, or ESG factors, when evaluating investments for a retirement plan. The DOL has released multiple directives over the years on this issue, but the guidance has alternately encouraged or discouraged the consideration of ESG by ERISA fiduciaries. The final regulations published this November replaced the 2020 regulations released under the Trump administration. The 2020 rules discouraged ESG investing by requiring fiduciaries to evaluate plan investments based solely on financial factors. ESG factors could only be considered if two investment options could not be distinguished based on financial factors alone. Fiduciaries would would have also been required to document why an ESG investment was chosen and could not have chosen an ESG investment as a qualified default investment alternative, also known as a QDIA. The DOL under the Biden administration announced in 2021 that it would not enforce those regulations. But without more concrete guidance, many plan sponsors and advisors were not comfortable including ESG factors in their investment analysis. The newest final regulations make clear that fiduciaries may consider the economic effects of climate change and other ESG factors on a particular investment or investment course of action when they analyze investments for the plan and when they exercise shareholder rights, such as a proxy voting. As always, fiduciaries must still meet the ERISA duties of prudence and loyalty, which require a focus on relevant risk and return factors. Fiduciaries cannot sacrifice returns, increase costs, or take on additional investment risks to promote collateral social policy goals. These basic fiduciary standards haven't changed under the years of conflicting guidance, but the new regulations do allow fiduciaries to consider ESG or other collateral factors they reasonably determine to be relevant to their risk and return analysis. Examples of collateral factors could include looking at a corporation's exposure to the economic effects of climate change, governance factors such as executive comp or accountability in corporate decision-making, compliance with labor, employment, environmental, or tax law, or progress with workforce diversity and inclusion. Relevant factors may also include due diligence and practices regarding supply chain management, including environmental impact and human rights violations, and labor relations factors, such as reduced turnover and increased productivity associated with collective bargaining. The final regulations also remove the documentation requirement for ESG investments chosen for the plan and permit the use of ESG investments as QDIAs, or qualified and default investment alternatives. Fiduciaries may also take participant preference for ESG investing into account when they're building an investment menu. The final regulations do not, however, require that fiduciaries consider ESG factors for every planned investment. Fiduciaries have the discretion to determine when they are relevant to their fiduciary analysis. If you're interested in learning more about ESG investing, I can provide information on investing strategies and alternatives. I can also help you design and document your process for selecting and monitoring planned investments to incorporate ESG. Let's move on now to the Treasury Department and IRS. The Treasury and IRS have responsibility both for providing regulatory guidance and enforcing the tax-related laws for retirement plans, which typically affect the plan document and plan operations. The IRS has recently announced tax relief for certain missed beneficiary payments and the new contribution limits for retirement plans for 2023. Let's review these changes and how they affect your plan operations. The IRS released proposed regulations last year to implement the changes to the RMD and beneficiary distribution rules brought by the Secure Act of 2019. Commentators on the proposed regulations indicated surprise at the IRS's interpretation that beneficiaries who are subject to the 10-year rule and who inherit from a participant who died on or after their required beginning date must take annual life expectancy payments each year of the 10 years that they're entitled to hold the inherited account. Many in the industry thought that the 10-year rule would operate similarly to the old 5-year rule, and that beneficiaries could wait until the end of the time frame to take a payment from the account. Because of this confusion, the IRS has announced that it will not assess the 50% excise tax on beneficiaries who were required to take a payment in 2021 or 2022 under the proposed regulations. Defined contribution plans that fail to make a beneficiary distribution described in this relief also will not be treated as having a qualification failure merely because the distribution was not made. This relief applies to beneficiaries who are required to follow the 10-year rule and who inherited a plan account from a participant who died in 2020 or 2021 after starting RMDs, or another beneficiary who was taking life expectancy payments and died in 2020 or 2021. If you have any questions on this, I can help you work with your TPA or record keeper to get more details on how this new distribution rule may affect your plan beneficiaries. The fourth quarter also brings us the cost of living adjustments that will be applied to the dollar limitations and thresholds for retirement plans in the coming year. In some years, the changes in the cost of living index do not meet the statutory thresholds to trigger increases. But with the current inflation rates being so high, all the limits will be increasing accordingly for 2023. These increases might allow you and your employees to save more for retirement if you're already saving the maximum allowed. They could also affect your non-discrimination testing results. The Social Security Administration sets the taxable wage base, which will also be increasing for 2023. This chart compares the limits for 2023 with the last few years to illustrate how the dollar amounts can change from year to year. Let's review the purpose of these limits to help you identify any areas in which your plan could be affected by the new limits. The maximum amount a participant may defer from their paychecks into their 401k and 403b plans for 2023 is $22,500. If they work for more than one employer, this limit applies to all pre-tax and Roth contributions. Individuals who participate in a governmental 4057B plan have a separate $22,500 deferral limit for that plan. Payroll and plan operations should be adjusted to allow for this increased deferral amount. Participants in a 401k, 403B, and governmental 457B plan who are aged 50 or older may be permitted to defer an additional $7,500 each year over the elective deferral limit, plan limit, or testing limit. 403B plans and governmental 457B plans may have special catch-up provisions in addition to the age 50 catch-up. The total amount of employee and employer contributions, including forfeitures, that may be allocated to a plan participant's account for 2023 cannot exceed the lesser of 100% of their compensation or $66,000. Catch-up contributions are not included in this limit, which makes it possible for a participant age 50 or older to save $73,500 in a retirement plan in 2023. Only a certain amount of a participant's compensation may be used to calculate the amount of an employer contribution the participant should receive. For example, if you're making a 10% profit sharing contribution for 2023 and a participant earned $400,000 in compensation, you may only calculate the profit sharing contribution for that participant based on $330,000, the compensation cap for 2022. An increase in this limit can result in higher contributions for highly paid employees. For 401k non-discrimination testing purposes, you and your employees are categorized into highly compensated employees, HCEs, and non-HCEs. The ADP and ACP tests limit how much may be contributed by or for HCEs based on the percentage of compensation contributed by or for the non-HCE group. An increase in the compensation amount to qualify as an HCE may change the number of employees included in the HCE group, which may affect your ADP-ACP test results. An owner or employee will be considered part of the HCE group if they own more than 5% of the employer at any time during the current plan year or preceding plan year, or they earned more than the HCE compensation threshold in the preceding plan year from the employer. So for 2022 plan year testing, you would look to the compensation threshold in effect during the preceding year or 2021, which is $130,000. The new $150,000 HCE threshold amount will not actually be applied in this way until 2024 plan year testing is conducted. Plan sponsors may choose to apply a top paid group election to potentially minimize the number of HCEs based on compensation. You and your employees are categorized in another way for another non-discrimination test run at the end of the year. The top-heavy test is based on key and non-key employees. This test measures whether plan assets are concentrated in the accounts of the business owners or officers of the company, who are the key employees under the tax rules. If the plan fails the top-heavy test at the end of the year, it will be considered top-heavy for the next plan year, and a non-elective contribution may be required to be made for the non-key employees. A key employee is an employee who owns more than 5% of the employer, or owns more than 1% of the employer, and has annual compensation of more than $150,000, or is an officer of the employer and has compensation of more than $200,000 for the 2022 plan year testing. You may want to review all of the 2023 cost of living adjustments with your payroll staff or payroll provider to make sure that all necessary adjustments in operations are made. This is also a good time to confirm that the correct definition of compensation is being used for plan operations. Let's close our discussion today with a review of the compliance deadlines for your plan coming up right after the new year, right now. Knowing these are on the horizon can help you prepare to work with your service providers to maintain compliance and address any participant issues that arise. January 31st, 2023 is the deadline for sending IRS Form 1099-R to anyone who received a distribution from your plan in 2022. Your record keeper or other service provider will generate this reporting for you, but you may receive questions from participants who do not understand. For example, why they received the form indicating taxation when they completed a rollover, or what the dollar amount or year means in the designated Roth contribution reporting box. Our team and your service provider can help you field these types of questions. February 14th, 2023 is the deadline for sending fourth quarter 2022 account statements to participants for 401k plans and other individual account plans that allow participants to direct their own investments. This is another statement that is generally produced by your service provider. Again, I can help with any questions from any participants that may come up, especially regarding fees or lifetime income illustrations. And finally, if your plan fails the ADP or ACP test for the 2022 calendar plan year, March 15th, 2023 is the deadline to distribute if you want to avoid paying the 10% excise tax. Most service providers begin collecting information from plan sponsors right after the year end. So you'll want to watch for communications from your record keeper or TPA regarding year-end testing. And of course, provide complete and accurate information for them as soon as possible so that they can perform your non-discrimination tests timely and accurately. Once you receive your testing results, be sure to review your reports carefully. If you have testing failures, you want to act promptly to discuss correction options. I would be happy to review your testing results with you and to facilitate meetings with your service provider if needed. Thank you for taking the time to watch this video, and as always, please give us a call with any questions you may have.